Hello, my name is Troy Atkins, and I am the founder and owner of Atkins Capital Management. Atkins Capital Management is a housing advisory services company. I want to talk to you today about the key events that have transpired in the U.S. residential housing market during the fourth quarter of 2021. During the fourth quarter of this year, a review of the quarterly report on household debt and credit by the Research and Statistics Group for the New York Federal Reserve, and a review of the monetary policy actions of the Federal Reserve amid the COVID-19 pandemic and the growing threat of inflation were the primary topics of conversation. This movie presentation also provides an overview of the home price level for a select group of cities that make up the Atkins 60 City Home Price Index, and it provides a wealth of information for prospective homebuyers to use in order to make a prudent home purchase decision. This presentation was written, narrated, edited, produced, and published by Troy Atkins. I am the founder and owner of Atkins Capital Management. Atkins Capital Management is a privately owned and independently operated company. Our exclusive focus is on residential real estate. ACM is not affiliated with any parties associated with the residential housing industry. Our mission is to bridge the gap in the residential housing market, where deficiencies in education, public policy, regulation, product structure, and personnel have created an environment where prospective homebuyers need objective information and useful analytical tools in order to help them make a prudent home purchase decision. As an investment professional, I have more than 15 years of real estate analysis experience, more than 10 years of institutional investment consulting experience, and more than 8 years of freelance financial writing experience. I am also the author of more than 25 published articles. For more information about my background, skills, and experience, please visit the Atkins Capital Management website. With this overview in mind, let me now turn your attention to a comprehensive household debt analysis that was conducted by the New York Federal Reserve. As illustrated in the chart below, mortgage balances shown on consumer credit reports stood at $10.67 trillion. Housing debt has steadily increased in an oscillating manner by more than $2.8 trillion since the second quarter of 2013. Mortgage debt, as a percentage of total debt, was at 70% at the end of September and has averaged 70% since the first quarter of 2003. Mortgage debt, as a percentage of total debt, reached a high of 74% in the first quarter of 2008. As of the third quarter of 2021, annual mortgage loan originations were at a historic high, with over $4.6 trillion in mortgages originated. There were $1.11 trillion in newly originated mortgage debt during the quarter, with 69% of it originated to borrowers with credit scores over 760. 2% of newly originated mortgages were originated to subprime borrowers, a sharp contrast to the 12% average seen between 2003 and 2007. As illustrated in the chart below, the share of mortgage balances 90 plus days past due remained at 0.5%, which was a historical low. The historical average delinquency rate is 3.04%, whereas the median delinquency rate is 1.67%. Mortgage delinquencies have steadily decreased in an oscillating manner since the first quarter of 2012. As illustrated in the chart below, the number of new foreclosures has been declining in an oscillating manner since the first quarter of 2012. For the 4 quarters ending in the third quarter of 2021, the new foreclosure rate was only 43.4 thousand. However, this historically low foreclosure rate was the result of the moratorium placed on foreclosures due to public policies put in place in response to mitigating the negative impact of the COVID-19 pandemic. Since the first quarter of 2003, there have been 14.9 million new foreclosures. Excluding the most recent 4 quarters, the historical quarterly average new foreclosure rate was 208.8 thousand. The highest annual new foreclosure rate of 1.996 million was experienced in the third quarter of 2009, which was during the housing crisis. The annual new foreclosure rate exceeded 1 million per year for the periods ending in the third quarter of 2007 through the third quarter of 2012. In view of the economic impact of the global COVID-19 pandemic, the Federal Reserve Committee maintained the target range for the federal funds rate at 0% to 0.25%. The committee expects that it will be appropriate to maintain the current target range for the federal funds rate until inflation has risen to 2% and is on track to moderately exceed 2% for some time, and when labor market conditions have reached levels consistent with the committee's assessment of maximum employment. In addition, the committee decided to complete the increase in system open market account holdings of agency mortgage-backed securities by $30 billion. The committee decided to reduce the monthly pace of its net asset purchases of agency mortgage-backed securities by $10 billion. And the committee will increase its holdings of agency mortgage-backed securities by at least $20 billion per month. Going forward, it is logical to conclude that mortgage loan interest rates will begin to trend upward as the Federal Reserve begins to gradually raise the target federal funds rate. This upward pressure on mortgage loan interest rates will likely be exacerbated as the Fed begins to slow its purchase of agency mortgage-backed securities, which in turn will put more pressure on the private sector to provide mortgage lending capital. Nevertheless, historically speaking, mortgage loan interest rates are still at very low levels and will likely remain at low levels for numerous years in order to maintain a stable housing environment. With this in mind, and in accordance with the monetary policy actions of the Federal Reserve, the national average mortgage loan interest rate for a 30-year fully amortized fixed-rate loan began the quarter at 3.18% and ended the quarter at 3.2%. In comparison, the national average mortgage loan interest rate for a 30-year fully amortized fixed-rate loan reached an all-time low of 2.67% on December 17, 2020, and the all-time high of 18.63% in October of 1981. Now that I have provided an overview of the events and trends that have taken place in the residential housing environment for the quarter, let me turn your attention to the proprietary finance-based analytical methodology and cloud-based residential real estate analysis software application that you can use in order to provide an assessment of the price level of homes in your community, as well as for specific home purchase opportunities. The Atkins Residential Home Valuation Analyzer is an internet-based software application that analyzes the relationship between the median home price level for a city and the median household income level for the city. With this information, the software application takes into account the most recent month-ending national average mortgage loan interest rate for a 30-year fully amortized fixed-rate mortgage loan and the assumption that no more than 28% of pre-tax household income should be spent by homeowners in order to repay the principal and interest costs for their mortgage loan. By utilizing this information, the Atkins Residential Home Valuation Analyzer can accurately assess the price level of homes in your city. From the first analytical perspective, the Atkins Residential Home Valuation Analyzer determines the level of underpricing or overpricing of homes in your city by calculating the mortgage loan interest rate that justifies the price level of homes in your city. With this information, the justified mortgage loan interest rate is compared against the national average mortgage loan interest rate in order to accurately quantify and assess the level of underpricing or overpricing of homes in your city. From the second analytical perspective, the Atkins Residential Home Valuation Analyzer calculates the percentage of household income that would have to be spent by the people that live in your city in order to justify the price level of homes in your city. With this information, the justified percentage of household income amount is compared against the traditionally accepted household income amount of 28% in order to accurately quantify and assess the level of underpricing or overpricing of homes in your city. By utilizing the Atkins Residential Home Valuation Analyzer, you can determine the level of underpricing or overpricing of homes in your community, as well as the magnitude of underpricing or overpricing of a specific home that you are considering to purchase. This, in turn, will help you make a prudent home purchase decision. For more information about our finance-based analytical methodology and the use of the Atkins Residential Home Valuation Analyzer, please review our finance-based analytical methodology report on the Atkins Capital Management website and watch the wealth of movie presentations that provide an overview of how the Atkins Residential Home Valuation Analyzer is utilized. With this overview in mind, let us now focus on the assessment of the price level of homes across the country. For the fourth quarter of this year, 28 cities that make up the Atkins 60 City Home Price Index were classified as overpriced for the quarter. Honolulu, San Francisco, Boston, Los Angeles, and New York City were identified as the 5 most overpriced cities in the index. In terms of a relative price level analysis, it is not possible to justify the home price level for the top 5 overpriced cities by reducing the 30-year fixed-rate mortgage loan interest rate from 3.2% to 0%. Therefore, in order to classify the homes in the top 5 overpriced cities as underpriced, it would need to be deemed prudent by prospective home buyers to spend more than the respective justified percentage of household income amounts. In order to justify the median home price level for each city, the median required household income level would need to increase to a level within the respective range of $133,964 and $278,813. Based on the median household income level, the quarter-ending national average mortgage loan interest rate, and the assumption that no more than 28% of pre-tax household income should be spent in order to repay the principal and interest costs of a mortgage loan, the justified home price level for the top 5 overpriced cities fell within the respective range of $326,681 and $606,707. Prospective home buyers should use the Atkins Residential Home Valuation Analyzer in order to assess the level of overpricing of homes in their community. On the other side of the spectrum, based upon the justified percentage of household income amount, 32 cities that make up the Atkins 60 City Home Price Index were classified as underpriced for the quarter. Detroit, Jackson, St. Louis, Memphis, and Wichita were identified as the top 5 most underpriced cities in the index. As part of this analysis, it is important to note that Memphis was classified as the 4th most underpriced city in the index due to its higher justified mortgage loan interest rate amount. With this in mind, in order to classify homes in the top 5 underpriced cities as overpriced, the national average mortgage loan interest rate would have to increase from 3.2% to more than the respective justified mortgage loan interest rate amount for each city, which fell within the range of 8.8% and 19.7%, or it would have to be deemed imprudent by prospective home buyers to spend as much as the respective justified percentage of household income amount for each city in order to repay the costs of a mortgage loan. Given the recent events that have transpired in the residential housing market, and taking into account the fact that buying a home will likely be the largest single financial transaction that prospective homebuyers will ever make, and the bulk of their net worth will likely be tied up in their home. Prospective homebuyers should use the Atkins Residential Home Valuation Analyzer in order to analyze residential real estate from 5 financial perspectives. First, prospective homebuyers should use the Atkins Residential Home Valuation Analyzer in order to assess the level of underpricing or overpricing of homes in their community. Second, prospective homebuyers should use the Atkins Residential Home Valuation Analyzer in order to assess the largest amount of money they should spend in order to purchase a home. Third, prospective homebuyers should use the Atkins Residential Home Valuation Analyzer in order to assess the amount of money they would need to earn on an annual basis in order to be able to afford to purchase a specific home. Fourth, prospective homebuyers should use the Atkins Residential Home Valuation Analyzer in order to assess total home ownership costs expressed as a percentage of household income. And fifth, prospective homebuyers should use the Atkins Residential Home Valuation Analyzer in order to assess how much a home would need to appreciate in value each year in order to offset the costs associated with owning the home. By assessing residential real estate in this manner, prospective homebuyers will be able to make a prudent home purchase decision. For more information about the Atkins 60 City Home Price Index, to watch our catalog of residential housing movie presentations, or to subscribe to use the Atkins Residential Home Valuation Analyzer, please visit the Atkins Capital Management website at residentialrealestateanalysis.com. This is Troy Atkins, saying thank you for taking the time to listen to this presentation.